Welcome, everybody. I'm Tim Profeta. I'm a senior fellow at the Nicholas Institute and a faculty member at the Sanford School of Public Policy. I'm really thrilled to be here today with all you and with our panel. I'm thrilled with this day so far. I actually want to note that we made Manuel optimistic, which I've been trying to do for 4 months in this project, and we've got him in optimistic mode. Just a word of introduction of myself. I just returned to Duke myself this fall from the Biden administration, where I was at EPA focusing on decarbonizing the power sector. While there was these few pieces of legislation that passed and sort of shook up our world. And the key to their success is how they motivate private investors to deploy investments on climate solutions, or as John said this morning, how the government will enable, but the private sector will lead in an IRA. So we're discussing really one of the most critical issues today. We're blessed with a tremendous panel here today. And to continue from last time, I'm glad we now have panels that have both people from the public sector and the private sector, because we talk about this partnership. It's good that we're on the stage together. First, I encourage you to read all of my panelists' biographies. But I give a brief introduction, but I'm not going to spend the time introducing. First to my left, we have Jigar Shah, who currently serves as director of DOE's Loan Programs Office, where he has vast authority to provide attractive debt financing to the type of projects for climate solutions that we need to transition our economy like we've been talking about today. And I really have to say, Jigar has recruited to DOE a tremendous team of financiers and experts and professionals that have given the administration a powerful, powerful tool to evaluate and invest in projects. Second, we have Charlie Gailliot, who is the global co-head of KKR's climate strategy, as that firm looks to its next frontier in these sectors. Charlie came to KKR from Goldman Sachs, where he also spent 2 decades focused on corporate equity, infrastructure, and climate. And then last we have Diana Propper de Callejon, who is a managing director at Cranemere, where she focused on investments that are driven by sustainability. Diana is really an OG investor in these fields, having spent more than 2 decades identifying and investing in these types of opportunities. So we're really blessed with the panel we have. We have too much expertise here with too much little time. So I just want to get us into the conversation right away. So let's just go down the line here, starting with Jigar. If you could sort of identify a little bit more your approach, how you describe your focus on investing in energy transition and climate solutions. Are there sectors in the supply chain that you're particularly focused on, or that your LPs, your investors, are particularly find attractive? Not for you, you don't have LPs. We're all your LPs.
So many LPs.
You're a single LP.
Yeah. And then lastly, though, how has the IRA and the BIL affected that for you? How has that affected your strategies? Jigar?
Yeah. Well, first of all, thanks for having me. This is an extraordinary collection of speakers that I've met here, but also all of you in the audience. I think the conversation that we're having here is, really important. We have an approach, I would say, to entrepreneurship and innovation in this country that is really unmatched, I'd say, around the world. But in the infrastructure space, we suffer from this huge problem where, particularly in the hard tech space, you've got a lot of folks who invest in A rounds and B rounds and C rounds, and then they get to the commercial project, which often costs $1 billion, right? And that's just a lot of money. It's been a lot of money, it's still a lot of money, it will be a lot of money. And so for folks like Charlie or folks in the venture capital space for sure, who are earlier stage, it's just impossible for them to put that kind of money in. And I would say in the past, commercial debt wanted nothing to do with a first-of-kind deployment. And so, folks really just had to 100% equity finance whatever it is that they wanted to do. And you can imagine in our space, hitting those kinds of rates of return that equity expects is just not possible. And that doesn't make those companies failures. It just means that we don't have the tools necessary to help them. And so I think the Loan Programs Office in this particular iteration is really trying to make sure that we are explaining to people what exactly the rules are to get access to that debt. And it's not easy. The the hurdles that we put in place are fairly high because we are supposed to reach this reasonable prospect of repayment, which means we got to have a fighting chance to get our money back. And that means that there's a lot of investment that has to be done in the front end, right? People have to do feed studies. They have to make sure that they really have done a lot of the work with their EPC contractors to make sure they know exactly what it's going to cost, all the offtake agreements, feedstock agreements. And so I would suggest that a lot of what we've done in the last 3 years is to help folks who actually are capable of getting through this process, but more so explaining to everyone else what it takes to be capable of going through this process. And that means investors, their advisors, the entrepreneurs themselves. We just find that this is not a muscle that a lot of folks know, and we can't lower our standards just to get people through the door, right? So figuring out how that ecosystem works and explaining to everybody so that they're ready when they need those resources has been hard. And then to your last question around Bill IRA, I do think that, as the sausage-making process was going through, thanks for passing those bills, Tim.
I'll take credit. The Loan Programs Office costs, quote unquote, less money than many other programs to the US government because the loan authority we have isn't a cost in Congress. It's really the projected losses that we might have that's a cost to Congress, and we've had a really good track record. So as the sausage-making process went through, a lot of folks looked at us as a way to provide a lot more money to the climate effort without having a higher score. And so as a result, we've received close to $400 billion of loan authority. And to the credit of my team, we've been able to attract about $263 billion of loan requests into the Loan Programs Office today. So there's certainly a lot of need in the country, and there's certainly a lot of responsibility in our team. And so really, happy to see the interest. Tremendous. Charlie?
Great. Well, thank you. Thank you for being here. This has been a great day to listen to everyone, and I'm excited to be part of it. So, Charlie Gailliot, as Tim said, I recently joined KKR after 20 years at Goldman Sachs in the private investment group there. And I started at KKR last year to help build and lead our climate strategy. And basically for us, what that's going to look like is to attack a specific piece of the value chain where we think there's a really good opportunity and maybe less capital formed today than is needed, certainly. And so what we're trying to do is invest in infrastructure-like opportunities, so in physical assets, the physical transition of the economy, but really in a risk-return way in between where the growth equity folks play and then ultimately where an infrastructure buyer might play in the future. So if growth equity folks are doing the Series A, B, C, D, and really backing the management team and doing a lot of that early stage development and the technology de-risking and all those sorts of really important things. And then an infrastructure player might want to buy an asset once it's fully contracted and built and it has a 15-year take or pay, and you can kind of underwrite that to a lower risk, lower return opportunity. What Jigar mentioned, the $1 billion in between to build and commercialize that opportunity. That's really what we're looking to do. And so we are going to start that strategy and start that team and look to deploy capital going forward. Building on what Jigar said with the loan office and the IRA, I think everyone can probably agree in this room, certainly, that it's really catalyzed a real transformation in the economy over the last 2 or 3 years, and we're just at the beginning. But a lot of opportunities we're looking at, and the Jigar's financing, they couldn't get that capital that debt capital wouldn't exist in a private context or in a public context. And so I think the Loan Program Office, if I think about something that's really different and essential, it's what they're doing here, because I don't think that capital is available certainly not at that cost, that really helps these companies get off the ground.
Can I ask one quick, can you give a couple examples of types of projects that fit in that middle ground that you're talking about to make it concrete for people?
So we invested in, our first investment last fall was into an electric bus business in the UK. So this is a business that it's the largest electric bus operator in the UK, but that means it has 1,000+ buses in a 300,000 market, right? And the rest of them are diesel, and they're going to go through a transition over, the government would like it to be by 2030. It probably takes longer than that just because of the sheer magnitude. But it's a business, right, that it owns buses. And so if you are an operator, You're going to lease those buses from us, but we will make sure that every single morning your 100 buses are fully charged and ready to run around the city of London. Because you're coming back to the depot, we know when you're going to charge and discharge. We know how far you're going to go, so we build a battery that's sized for your sort of route so we can manage our CapEx. But we own those assets, we own those buses, we own the charging infrastructure, we own the depot, and then we have a 15-year contract with you to go run your buses. But we want to take that platform from 1,000 buses to 10,000 buses. An infrastructure fund's not going to typically underwrite that sort of scale and that sort of growth. When we look at it, we say, okay, you've got assets, you've got contracts, you're not taking technology risk, right? We know electric buses work. You just need to build and scale. And those buses are expensive, $200,000 or $300,000 per. The charging infrastructure is expensive, so you need a lot of capital to get from A to B, and we're gonna help solve that.
Great, thanks, Charlie. Diana?
Thank you, and thank you again for inviting me as well. Yeah, I've been at a company called Cranemere for 10 years, just celebrating our anniversary this year. Prior to that, I was in venture capital and growth equity. Cranemere is very much focused on buyout and focusing on cash flowing businesses. And I think one of the things that's unique about Cranemere that I think is relevant to the story here is we were founded by Vincent May, who ran a big buyout shop for 20 years. And his thesis was that it was better to hold great businesses than to sell them in a fund structure. And that's not true for every company, but for a lot of companies, they might want to just stay private and independent and keep growing. So the way that Cranemere was founded is we are a holding company. Our shareholders own stock in Cranemere, and then we use that equity to acquire mid-market private businesses with no view to exit those companies. So it's a buy, build, and hold private market strategy focused on mid-sized businesses. And there's a couple of things that make that interesting. Number one, we've been able to attract a lot of founder-owned businesses who oftentimes are very committed to not only the growth of the business, but also the mission of the companies, the culture, the mission that they want to preserve. And also because we're long-term owners with no view to exit and no structural reason to exit, we can make investments in the employees and in the environment and sustainability that are very long-term minded because we know we're going to be able to capture the benefits, the financial benefits over the long term. So I wear two hats at Cranemere. One is to focus on sustainability companies that define themselves as such, mainly looking at in consumer and also in energy efficiency services. And the second hat I wear is I work with our industrials group to really help those companies push their decarbonization efforts. And I think that's what I want to focus on. Being long-term, we obviously see climate not only as a big risk, but also as a big opportunity, big markets. A few years ago, we partnered with a company called Velocity Vehicle Group. They're one of the largest dealerships in the United States that also offers service and parts for heavy-duty trucks, so mainly Class 7 and 8 trucks. When we started talking to the founders, who are still running the business, they really were very interested, partly based in because they're based in California, in over time pushing into electrification. Granted, this is going to be a very long journey, but given our long-term ownership, there was a real synchronicity there because we were very excited to help them invest behind the electrification process, make those investments again, because we knew we were going to be there to gain the financial benefits of expanding into that large market. So what we've done with Velocity in terms of how they've approached that, and again, you're thinking about big heavy-duty trucks. This is probably the longest time horizon in terms of being able to do electrification. But they have partnered with Daimler Trucks in North America to pilot 40 heavy-duty trucks around the West Coast, and where they've been doing that to really assess the performance of the vehicles, and Velocity, in tandem with Daimler, has begun to train the service technicians, since Velocity has a big service department, on training them in how to service electric vehicles. But very interestingly, what has opened up, and this is where it comes back to government incentives, is we've now, with Velocity, are pushing into the mid-sized truck for the first time, and have partnered again with Daimler with their Ryzen truck. This is where, typically you've got a 2 to 4x times more expensive for electric trucks than you do combustion engine trucks. The delta is a lot smaller with mid-sized trucks, so that IRA tax incentive is much more helpful in Ryzen. But I think one of the things that I feel that's important to say, and I think has been brought up, is we really need every single tool in the tool chest to make this happen. So it's the tax credits, but it's also regulation. If you look at California regulation in terms of mandating the move to electric trucks, what the EPA is looking at, we need that. We need customer demand, and there is customer demand now, unlike 10 years ago, in terms of companies making commitments to net zero, and their customers are coming to Velocity Vehicle Group saying, our customers want to see us go green, so we need to now start to buy electric trucks. And the last thing that's really important is, which has been something we've had to tackle, is ease of use, right? It's not just enough if you're a fleet management company like the company that Velocity has launched to do this with the mid-sized trucks. We're doing the fleet management, we're doing service, we're managing how to get the tax credits and we're also going to be setting up the service and the charging infrastructure, some on our own, some in partnership, so that it is a plug and play for the customer. And I think, for those of us who are survivors of Clean Tech 1.0, like I am, I can say that making the solution plug and play for your customers, so they don't have to figure out the financing, the subsidies, the service, the whatever. It's, here's the electric vehicle, and we will take care of everything. You just need to, drive the truck and do what you need to do, on the fleet.
That's great. First of all, I want to remind the audience that we are still taking questions through Slido. I'm actually answering the first Slido question I got on my panel, which is Slido working? It's working. They're coming up, and again, I'm going to try and synthesize. We got some themes already identifying themselves as we go. I want to get into take advantage of the fact that we have the three of you together to talk about the public-private partnership that's sort of inherent here. And how do you see the investments and the programs that IRA best deployed so we can sort of build those partnerships and sort of hopefully get to a place where private investment can sort of stand on its own? We've talked a little bit in preparation about things like, the LPO is doing a tremendous due diligence, as you were saying. Is there a way that can be shared across? Are there upfront costs on sort of ventures that might, but also how can the private investor class and the public investors from the LPO sort of best work in conjunction to sort of accelerate these transitions in these companies?
Yeah, it's a good question, and one I don't really have an answer for. But I'd say that what we're trying to bridge is, on this side, you've got a bunch of really smart people, many of whom went to Duke, who have put together models and policy prescriptions and all sorts of things that we then passed in the bipartisan infrastructure law and the Inflation Reduction Act. And then there's a bunch of people who've modeled the fact that we're going to have 40% emissions reductions because these things have passed, right? By definition, they're making some assumption that the tax credits and the loan program and other things are going to be used in such a way that it will result in 40% emissions reductions, right? And so then when you think about that conversation, right, there's always early adopters, right? Folks who presumably were going to do this anyway, and thank goodness that like this incentive came along or this thing happened, and now they're going to use it and their cost of capital went down or whatever it is, right? But the question becomes, on that margin, right, how do you have that level of dialogue around, what would it take for you to make this decision that you were going to make differently, right? What solution do we need to provide to you? I'll give you an example. For many of the sectors that we're working in, the planning costs are very expensive. And that money is just impossible to raise, right? If you're going to build a sustainable aviation fuel facility, it might cost $20 million in feed studies up front to be able to figure out, what are the costs and the feedstock and this and that, whatever. And if you go to like an investor and they say, well, show me your entire plan, well, the whole plan is theoretical, right? And so until you get the 20 million, you can't really get to the other side. So you can imagine that might be a grant that the US government provides depending on, you doing certain things. But I think that right now we're forced to guess at what a lot of the private sector folks want in those solutions, because I think that the level of communication between the private sector and the public sector is not necessarily as robust, I think, as it needs to be able to have them say, well, here's our vulnerabilities, here's where we're not seeing the incentives really lining up enough for us to make these decisions, and for us, to say, well, we have flexibility in these 3 areas, maybe we can make changes here. So I'd say that, the last 2 years in my mind have been spending a lot of time thinking about how we actually take these extraordinary programs and implement them and get them out the door and all these other things, which is great. But I do think that if we're going to get to that next level of emissions reductions that we're all modeling for, there needs to be a greater level of communication and partnership.
Charlie?
I think that's a great point. It's the money is there and it's available. But you access things when there's transparency and there's communication. You can underwrite to it, right? Because investors don't like uncertainty. And so, honestly, so besides the actual legislation, clearly there's been a push from the administration to communicate, right? In working with the folks in Jigar's office, or Leslie was here and we've been talking to them, or talking to the White House. There is a real outreach program that's palpable to kind of say, okay, the government, we've done this, we've kind of done our part. Now, how do we unlock it with you, and what do you all need from us? What do you need to see and hear, and how do we work together, in partnership to move this forward? And so I think that's a different approach, I would say, to all of this than you usually have seen from government. Yeah. And I think if you really want the private sector to get behind it, then to underwrite it, opening the kimono a bit, I think is extremely helpful.
Yeah, and just, I guess, keeping with the theme I started with, in terms of looking at big, industrial areas for decarbonization, and our strategy has been to find mid-sized businesses that might be more entrenched in today's economy, like Velocity Vehicle Group, obviously selling mainly combustion vehicles, but wanting to move and be a leader in the future of green technology. I think that there's more that we can probably be doing to learn, what types of subsidies, tax incentives, and the like might be available from the government. I know we help our customers at Velocity Vehicle Group access the tax credits from IRA, but just in talking to Jigar at lunch about our new fleet management company for this mid-size Ryzen, understanding some of the other opportunities that there might be to knock on the door. So we had to meet here at Duke to do business, but that's a good thing. And then I would just say that certainly in the big industrial areas, that even looking at Velocity Vehicle Group, steel is a huge component of the trucks that are driven, talking about Scope 3 up the value chain. Velocity Vehicle Group doesn't have much power in terms of mandating green steel, but that Cement, steel makes up about, what, 14%, 13.5% of global emissions. And, but getting green steel out into the marketplace will be huge, through getting, enabling companies like, Volvo, Daimler, Ford to be able to provide companies like Velocity with much more low carbon vehicles. So I know there's been quite a bit of, I think it's only about $6 billion in private equity and venture capital that's gone into, green steel. Hopefully that will be, green hydrogen. Hopefully that will be something that will be expanded.
So let me stay here in terms of the partnership one more moment. Actually, teaching this semester on industrial policy, there's a concept called embeddedness, which is how embedded should the two sectors be together. And it's kind of a Goldilocks point. You want it to be enough so that the government can benefit from the knowledge of the private sector, but not so much that the government's a threat of capture by the private sector. Do you have any thoughts on where that Goldilocks, other than Duke convening events like this, which we're happy to be part of it, how do we get that conversation between you and Jigar happening as proactively as possible, but still as transparently and openly as possible, that there's not a risk, with somebody who's not Jigar of capture by the government agencies, by the private sector? Any thoughts on sort of how does that relationship best structured so that the government's industrial policy is best guided by the knowledge from the investment group? We can start with Diana, or we can start with anybody who has a thought on it.
I mean, I can start. Look, we have thousands of conversations. We have 50 people in our outreach and business development team. I think one of the things that we do at LPO is, whenever there's a sort of specific piece of advice or counsel or, breakthrough that sort of occurs, we immediately write it up and post it on our blog, right? So that way it's not just Diana that's benefiting from it, but that, everyone can benefit from it. So we try really hard to make sure that everything that we capture in that way gets sort of memorialized and then published. I think the other piece that we do is, I think we do like 7 outreach events a week. And so, we're constantly trying to figure out how to talk to many. I think the DOE broadly has put together a lot of these data points into what we call liftoff reports, right? So we have the nuclear liftoff report, long duration energy storage, carbon management, hydrogen. Most recently, I think we published additional projects around virtual power plants and other things. And so I think grid modernization and geothermal is coming out soon. And so with that, we're trying to actually assemble all of this feedback we're getting from the private sector and then disseminate it back out as a fact base that, everyone can, work from, so that, we're not all talking past each other, et cetera. And so my sense is, and then we had the Deploy 23 conference last year, which I know brought together a tremendous number of companies, big investors, but also labor leaders, justice leaders, et cetera. So frankly, a lot of folks just haven't met each other before and just figuring out how, we all work together in a better way to do this. I think, the capture issue is a really big problematic thing. I think in LPO broadly, part of the way we do that is each one of our loans, I think, is touched by over 100 people before it gets through the office. So no one of us can really push a loan through the loan program's office. And so it really is a team effort, and there's, active desire for people to dissent if they don't like something or whatever it is. And so, but yeah, I mean, institutionalizing that has been a big goal of what we're doing.
Yeah, I mean, I think the sophistication of the loan program is almost in the DOE grant program is almost in its simplicity, right? If it's viewed as capital that's coming in to help catalyze an industry, it's not taking ownership, because I think that probably crosses that line into government ambiguity. But it's here to reduce the cost of capital and to really get early stage industries or companies off the ground, where otherwise it might take 20 or 30 years if left to kind of private capital devices as it slowly went through its technological journey. And so in just providing capital to early stage businesses with kind of no expectation or strings attached, in a major way on ownership and all that sort of governance type stuff, that just fundamentally is a tool that helps something get off the ground that otherwise it might not or would take forever. And so if we look at it very simplistically as private investors, that's just reducing the overall cost of capital. And I think that's honestly, in its simplicity, is why it's working. It's so effective.
Yeah, I would agree. I think the fact that the DOE has both the grant program as well as the loan program, is interesting, depending on where a company is at. And I know that the intent is really to catalyze private capital to come into the space, broadly speaking. And again, I think it's more than just the government incentives. There's got to be, there's got to be the carrots, there got to be the sticks, but there has to be customer demand, there has to be technological innovation. I think what we're seeing now is much more private capital coming in, whether it's credit, equity, venture, because you've got this really confluence of forces coming together at the same time, right? I mean, it's very different than the last time there were government incentive programs, for clean energy and the like, because we simply didn't have the level of technological innovation, cost reduction, companies now making commitments to net zero, which they had not made 10, 15 years ago. That drives things, and just a lot more sophisticated investors having gone through clean tech 1.0, 2.0 to know, what to stay away from. We're much more savvy about China, and what makes commercial sense and what doesn't make commercial sense. So, but I think the role is really like, how do you catalyze private capital to move into the space?
Now we're coming down close to the end. There was something actually that I think, Charlie, you said about early stage companies, and I was thinking about Leslie on the last panel talking about how we need to be able to work with the incumbents as well. Could you all speak to a little bit about whether your investments, your programs are aiming at more of the emergent and disrupting companies, or if there's a way for the IRA also can be really deployed to help the incumbents and the LPO generally, specifically IRA generally, the incumbents transition to zero carbon as well?
So I'll say we've spent a lot of time, and certainly in some of the industries that you mentioned, like green steel and green cement and all those, and I think those, for us at least, seem better approached in a partnership with big strategics who have built the old carbon intense footprints and are now trying to transform their business into a much lighter footprint. And so when we think about that, they know how it's done. They have the technology. They can provide the offtake. And now, you need hydrogen to power your steel plant, or you need ammonia for your fertilizer, or you need methanol for your shipping, or whatever it is. But in partnership with those big corporates, that's how we see those industries kind of the best place to play, as opposed to saying, I'm going to build a hydrogen plant, and then I'm going to try to make some ammonia, and then I'm going to go find a couple of buyers for that product, right? That's probably a pretty risky proposition. And so in partnership with big corporates who have to get there anyways, and maybe don't have public shareholders that want to put in $2 billion today and with no return on that cash for many years. And so figuring out how can we partner with them to help them kind of get on their journey for the next 20 years.
Great.
Yeah, so I guess, yeah, I would agree that, when something is extremely capital intensive to do, whether it be, green hydrogen or green cement, or frankly, developing heavy duty electric trucks, we have to work with incumbents, right? I mean, yeah. Velocity distributes electric trucks with Daimler, but they're not building the trucks. That's a scale, magnitude that's way too big. But I think there's some, they're the disruptors, and when you say disruption, I was thinking like venture capital, like really disruptive. Yeah. I think the medium-sized companies are semi-disruptive, but they also might have a 1 or 2 feet firmly implanted in the old economy. And part of what we do is find the leaders in the old economy, like Velocity, who want to move into the green economy, the low carbon economy, and invest behind them over the long term to get there. We also have a company in bathroom products called ES Group. They are basically replacing acrylic and ceramic in sinks, bathtubs, shower trays. It's overall has a much lower environmental footprint in the manufacturing of the product, and there's a huge materials replacement going on in Europe around this. It's starting in the United States, so it's a slight disruptor, but again, it's not going to, it's had partnerships with larger companies, to get to where, it is. So I think it's a mix of both.
It's a really weird thing, right? I mean, we're talking about billions to trillions, right? And so we're trying to figure out how to actually decarbonize, you guys pick a number, 17 sectors or so. From hydrogen, we talked about steel and cement, we talked about long duration energy storage, right, nuclear, et cetera. And so I think when you think about the way modern finance is structured, it is clearly structured on a credit basis, right? So S&P, Moody's, right, the Federal Reserve, interest rates, et cetera. That is rarely where disruption will come from, right? But it is where finance is comfortable, right? And so we sort of have to live within the sort of architecture that we're in. But I do think it's critical to recognize that no one would be doing electric vehicles if Tesla didn't do electric vehicles in 2009. Like, it's not like this was a natural outgrowth of the Chevy Volt from 2009, right? And no one would be looking at heavy trucks. Like, Daimler and Volvo are nowhere, right? The only reason they're even thinking about it is because they're afraid of Tesla Semi, right? And so I think when we think about how this disruption occurs, I mean, I helped pioneer a lot of the solar financing stuff, but also we did the first $1 billion into renewable natural gas when I was at Generate. There's no chance that Shell was doing renewable natural gas if we hadn't done the first $1 billion of natural gas for dairy farms and that kind of stuff in Indiana. So I want to make sure that we're very clear about where disruption comes from and the people who are behind disruption. They're not great people half the time, right? A lot of times they're people that you don't like, right? But they are the ones who are actually making it happen. I'll give you an example. Met this guy, not a nice guy at all, but he basically figured out the California ADU market, this auxiliary dwelling unit market, and he has a 3D printing approach to, I think, making houses that are 800 square feet, right? Think the old Sears Craftsman home for $110,000. Right? Think about how many people live in double wides, particularly here in North Carolina down to Alabama, that basically die when a tornado comes through, right? And these things are 140 mile an hour winds, the whole 9 yards, cheaper than double wides. I don't think Warren Buffett's, what is it, Clark Construction or whatever it is, which is the largest producer of manufactured homes in the country, they're never gonna do this. If this crazy guy wasn't doing it, they wouldn't move the whole market, right? So I think we all need to recognize that is where disruption comes from at trillion-dollar scale, right? Those are the people who do crazy things. And then they make incumbents jealous, and the incumbents go, crap, this person might hurt my business. Maybe I should set up a division that does this and competes with this person. And we're there for both of them, right? The loan programs office wants to help both of them. Right?
We only want the second one.
Right.
No crazy guys in our portfolio.
Right. but I just we all I just want to make sure everyone in this room recognizes what the unique version of American capitalism allows for. And it sucks sometimes because you're I don't like this guy, but this is the guy who's doing this thing, or I don't like this woman, but this is the woman who's doing it, right? And so that's sort of how this works, right? And so we all just need to recognize the diversity that we're going into and how important each one of those players is to actually making this massive change that we're trying to accomplish, right? And we're not going to get to trillions without all those folks.
First of all, I know there's something absolutely quotable about what this last passage here about. We are at time, but I'm going to ask one more question anyway, with apologies to the event organizers, because I want to be true to Slido here. There's a lot of conversations about political durability, so maybe just in brief, one of the concerns that we've heard today, people often voice, is the lack of political durability for government policy like the IRA. How do you assess that question as you think either as how to deploy the LPO's programs or how to design your own firm's investment strategy, as you're looking at this wonderful host of opportunities the IRA is giving, but the idea that political winds could change, and how durable are these programs?
It's a great question. We absolutely have to be cognizant that there's a big election in this country in November, and all of this might look, pretty different depending on that outcome. I think we and certainly I do, but we're all also a victim of the fact that we only think about the United States. There's something like half the world's population is voting this year. So our problem is also, Germany's having it, the UK's having it, India's having it, right? This is not just a US problem, and populism and all the other stuff that comes with it is on the rise everywhere. And so we're trying to figure this out everywhere. But it's hard, to think about, Jigar's office specifically, if they're working with a company and that's part of their funding plan, like, is that money coming before November? And if it's not, we have to take a view on, can we depend on it? And so there are big questions.
Will you take a post-dated check?
So we're doing that work, But there's other things that have been, like, it would be great if it didn't take 6 or 7 years to develop solar in California, and that's not really a White House problem. And so there's kind of regulatory uncertainty everywhere, and it's part of the Rubik's Cube of figuring out whether you want to make an investment, for sure.
That's great. Any pithy, quick answers since we're over time?
The only thing I can say is we tend not to, I don't think that things might go slower if there's a big change in the opposite direction. I don't think it stops things in its track. There's too many other factors, as I mentioned before.
Yeah.
And I guess the only other good thing about the last 2 years or 3 years since COVID is companies are a lot more resilient and have learned to manage through massive chaos. So hopefully that comes in handy.
All right. With that, let's thank you, panel.